Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
Today, I thought we would drill down into a very interesting aspect of analysis of whether a business is wonderful. So overall, when we're making good investments, we want to invest in wonderful companies. And how do we know that they're wonderful? We look at various things like moat and management and so forth. So we're going to drill down into management, and there's a couple of ways we know if management is wonderful. And we're going to drill down into the one aspect which tells us if they're wonderful or not in a particular way. We'll drill down to other aspects in different videos. Today, I want to talk about how the management allocates your capital. And the reason that this is something that's important is when we, as value investors, buy shares, we imagine that we are, and in fact we are, the owners of the company. So if you were to buy the entire company, the CEO effectively is working for you. He is allocating the money that the business generates, and he's choosing what to do with it. And you need to know that he's doing the stuff you would want him to do, because effectively that's your money. That free cash flow that he has choice to do stuff with, if you own the whole business, you could choose to have the free cash flow go directly into your bank account, because that is your money. And as a shareholder, determining if he is managing your money the way that you would want him to manage your money is critically important. So we're going to look at the different ways he can, what choices he has, and whether they're good or not under various circumstances. But before we dig into the different ways, I thought maybe we'd hear from Eugene. What do you think of today's topic?
Yeah, this is, I think, one of the most important topics, because this particular thing is a great indicator of how the well management operates in the company. And even though they are great promoters of the business, they do the right job increasing the revenues and net income and having free cash flow and low debt, etc. Still can be the problem with allocating capital, because not so many managers can do it well. And particular looking at this indicator will help us to distinguish the average management from the outstanding one. So the first one is paying back the debt, because usually when you do the big business and you like the billion or trillion company, you have a lot of debt in order to increase your scale, in order to be ahead of your competitors. And this can actually affect your financial position when the market hits the bottom or the economy is not so great. What do you think about that, Nick?
So debt is a very good one to start with, and I'm glad that that's the one that you chose to start with. There's two ways of looking at the debt that I like to look at it when I'm analyzing the debt of the company, and is management increasing or decreasing the debt. So firstly, if you're buying a company, in like an entire company, like say you want to buy like a bar, you buy everything. You buy the assets, and you also buy the liabilities. So if the business has debt, when you buy that business, you now owe that debt. And so when you're buying a company, you need to look at the assets and revenue and the debt. You take that debt out of the value of what you've calculated for the business. So if you value a business at $1,000 and it has $500 debt, is that business really worth $1,000? Maybe it's only worth $500 because you've got to minus away that debt. And so that's one way to look at it. When CEOs pay down the debt of the business, they're increasing the value of the business that you own. And so that's definitely one angle to look at it. And the other is we like low risk and high certainty. And if management has the debt too high, if trouble comes, unexpected trouble, they might not be able to refinance the loan, or get a better interest rate, or even pay the debt if it's too high, and their cash flow goes down for some reason. And so, if their debt is too high, they're actually risking your entire business. They could declare bankruptcy and you lose everything. Effectively, debt is a very important thing to monitor from that perspective as well. Personally, I like to know that they could, if they wanted to, pay the entire debt with just 3 years worth of free cash flow. For me, higher than that starts looking a bit more risky. Other people have different metrics. They want to look at maybe the assets and they compare it to the debt. You'll find your own path, but essentially, how they manage the debt is how they use your free cash flow. You need to know, is it benefiting you? Is it the right time to do it? Or is it better to spend on one of the other things we're going to discuss? Effectively, you can always calculate what's the best move at the best time. So you'll compare the long-term debt interest rate with the amount of return you would have gotten from one of the other choices, and you can make an informed decision. Are they making a choice in your benefit? Is it growing your company? Was there a better way to spend the money? And you've got to make some judgment calls like that. What do you make of that?
Yeah, I definitely agree. And you can do the calculation just looking at the balance sheet for the long-term debt line, and then go into the cash flow statement and understanding how much percentages and money they pay in order to manage this long-term debt. But the way I also think, besides the free cash flow to debt, I look at the current assets of the company, thinking that if something unexpected happens, what will be the company doing with their long-term and current debts? And do they have current assets in order to sell them immediately, or do they have enough cash on hands in order to just fulfill all their obligations? For me, it is number one priority, because if the company can manage it, and if the company substantially decreases their total liabilities and the long-term debt, and ideally it has zero long-term debt, it will hugely affect their net income and net margins and every margins of the business. And actually, it will increase the price of the stock, because the investors can just value this as the more stable, financially stable business, and can increase the PE ratio of this particular stock.
Let's talk about dividends, as that's a good next option, I think, to talk about. Effectively, dividends means that of all of the allocation choices, of the five major choices that we're going to discuss, dividends is the choice that they make when they believe that they don't have a better way to spend your money to grow your share in the business, or lower the debt, or improve things in a way that you would approve of. If they can't get a return on invested capital with that money, that the dividends means that they pay you the money directly. So they just divide up the amount of money that they're not going to spend on other things, and they just send it directly to you. And that's what a dividend really is. What are your thoughts on dividends? I've got a few more thoughts, but let's hear a bit more from you.
Well, I look at the dividends at the last part of my checklist, because even though it's like the pleasant bonus for you when you receive the paycheck, for me it's not the substantial, because as you said previously, it's like the last chance for the company to bring the value to shareholders. So if they do not have any other option, like buy back their shares, or paying the debt, or acquiring some competitor or new business to increase their return on invested capital, they can just pay the dividends. I compare this number with the return on investment, and I try to calculate how the return on invested capital indicator will improve if they do not pay dividends at all. And I prefer to look at the companies which do not pay dividends. It's my personal strategy. I do not think that this is 100% right. It's definitely subjective and optional for everyone. But for me, it's like the great indicator that the company has plenty other options to spend my money as the shareholder.
So there's pros and cons to dividends, and one of the cons, what's bad about dividends, is now you have to find allocation that'll grow your money at the rate that that you want to grow it. But now the onus is on you to discover another great investment or put it back into the company. And when you receive dividends, you now get taxed on that. And so you're shrinking that money that the business has earned by that amount of tax. But if they don't pay it out to you and they grow your money instead, there's no additional tax that dividend that you would have received would have been taxed. And now, if they don't pay it and they rather grow it, you avoid those taxes, and you don't have to go and find something that will grow your money faster. Often a wonderful company will grow your money much faster than the rate of 20%. And so getting paid out and then having to go and find a good growth rate is very difficult.
I also want to add that if you consider dividends while evaluating the company and you have slightly different strategy, you need to know that in most cases, companies which pay high dividends can be like established, well-branded businesses with slow growth rates. So they can be like cash cows, like Coca-Cola, which is already established and usually it's rarely growing, but it's pay high dividends because they do not have any other options to distribute the cash. Or this can be the ring for you to dig deep into the company, because if the company pays high dividends and it has a lot of debt and it doesn't acquire any competitors or new businesses and it's still growing, this can be a value trap or dividend trap.
So my final thoughts on dividends before we move on to the next one is when you're calculating a return, let's just say that you found a company that has a very steady growth rate. Let's just say it's 9% a year, and it's been doing that for 20 years. Just imagine for the sake of this example, but it's paying a 3% dividend. Now you can count on, and a lot of people don't do this, but you can count on a growth rate of your capital of the 9% plus 3%. So now you have an 11% growth rate of your capital. It's just something to consider to add the two together, the growth rate that you're expecting, along with the dividend. If you have two identical companies, sometimes looking at it in this way will help you choose between the two. A lot of people think that dividends is the best thing for somebody who's maybe entering into retirement, and dividends is kind of the holy grail because it's cash flow, and they don't have to sell any shares, and they get that cash flow every quarter, and they try and build up a really big dividend portfolio. And for a long time, this was considered really good advice. But I've looked at studies that show that if you have a wonderful company that doesn't give dividends and you sell the amount you need to survive that you would have gotten from dividends, you still end up far richer than if you had a company that paid dividends that wasn't as wonderful. So find those wonderful companies and forget about dividends, in my opinion. If it happens to have dividends, factor it into your calculations or take it as free money. But to me, it's like the CEO admitting that he does not know what to do with that money to grow your money for you, which to me indicates maybe not such a great CEO. Just a thought on that. Sometimes it might be the right thing to do, but I personally, I don't even look at dividends or whether it pays or not when I'm doing my calculations.
But anyway, this is all for today. We will discuss other options which management can use in next episode. If you have any questions, please write down them in the comments below. Also, we would like to invite in our Discord value investing group, where we discuss different videos, books, gurus, stock ideas. And we also have weekly free meetings when we discuss book chapters, stocks ideas, and other stuff. You can find all the information in the description. Thank you for watching and see you next time.